Most people think markets panic when bad news hits the screen. They don't. Markets have already priced in bad news by the time it becomes loud enough for everyone to hear. What actually unsettles a market is quieter than that. It's the moment when something important changes, but no one is arguing about it yet. No headlines, no urgency. Just a subtle shift in behavior that doesn't fit the old story anymore. Right now, many investors are still reacting to what already happened. Last week's data, last month's narrative, last cycle's assumptions. That's comfortable. Familiar problems feel manageable because we've seen them before. But markets don't move on familiarity. They move when familiar explanations stop working. When price behaves differently than it should, when liquidity acts strange, when participants start hedging instead of reaching without ever saying why. That's the uncomfortable part. Not bad news, but unanswered questions. If you're waiting for clarity before adjusting your thinking, you're already late. Clarity usually arrives after positioning has changed, not before. The market doesn't announce transitions, it leaks them. So the real task isn't predicting the next headline. It's noticing what no longer reacts the way it used to. That's what we're going to unpack calmly, without drama, and without pretending certainty exists where it doesn't. Over the past several weeks, the precious metals market has moved in a way that looks ordinary at first glance. But the sequencing matters. Silver and gold prices have remained range-bound relative to recent highs, with short-term volatility compressing rather than expanding. Spot prices have fluctuated within levels already established earlier in the quarter, without decisive breakouts in either direction. This is a contrast to the sharp directional moves seen during previous macro-driven episodes. At the same time, physical market activity has shifted. Coin shops and bullion dealers have reported an increase in inbound supply, more holders selling or trading metal back into the market, while retail buying has continued, but with smaller average order sizes. The change is not a collapse in demand, but a change in behavior. More two-way flow, less one-sided urgency. On the wholesale side, premiums on common silver products have gradually normalized compared to the spikes seen earlier in the year. This suggests that immediate supply stress has eased, even though inventories remain uneven across products and regions. There has been no broad inventory glut, but the shortage narrative has softened. In parallel, verification practices across the physical market have tightened. Dealers are spending more time per transaction testing, weighing and validating incoming metal. This has slowed transaction throughput in some locations and increased operating costs, particularly for smaller shops. These measures are a response to higher volumes and quality control risk, not to price movement itself. Importantly, none of these shifts occurred suddenly. There was no single announcement, no policy shock, no one-day event. The changes unfolded gradually over weeks, visible only when comparing current conditions to those of last month rather than yesterday. Compared to the prior period, the market today shows slower turnover speed, more cautious inventory management, greater emphasis on verification over volume. No conclusions are implied by these facts alone. They simply describe the current operating environment as it exists now, not as it is expected to become. What matters here isn't the price sitting on the screen, it's the mechanics underneath it. When a market shifts from one-directional flow to two-way flow, the first impact isn't volatility, it's friction. Transactions take longer, spreads widen slightly, decisions slow down. None of that shows up in a headline, but it changes how capital moves through the system. The first group affected is not investors, it's intermediaries. Coin shops, wholesalers, refiners, and logistics providers feel this before anyone else. More metal coming in means more testing. More testing means more time, more labor, more equipment use. Margins don't vanish, but they thin. Throughput becomes the constraint, not demand. The second-order effect follows quietly. When verification costs rise, risk tolerance drops. Dealers become selective. They reduce size, not exposure. Fewer large lots, more broken-up transactions. That changes liquidity quality. The market still trades, but it does so in smaller, more cautious increments. For investors, this environment alters feedback loops. Price no longer reflects urgency, it reflects balance. That can feel confusing. People expect tension to express itself through price spikes. Sometimes it doesn't. Sometimes tension expresses itself through hesitation. Another knock-on effect appears in sentiment, but not the loud kind. Instead of excitement or panic, you get disengagement. fewer strong opinions, more wait and see. That often precedes inflection points, not because it predicts direction, but because it signals exhaustion of the prior narrative. This also reshapes how information is processed. In fast markets, data dominates. In slower markets, interpretation does. Two investors can look at the same numbers and walk away with opposite conclusions because the market is no longer forcing alignment. None of this implies stress in the system. It implies adjustment. Markets periodically reprice risk, not by moving sharply, but by redistributing who is willing to hold it and under what conditions. The key takeaway is simple but easy to miss. When operational behavior changes before price does, price is no longer the leading indicator. It becomes the summary delivered later. That's why this phase matters. Not because it's dramatic, but because it's preparatory. The groundwork for future movement, up or down, is usually laid during periods that feel uneventful to anyone only watching charts. There have been other periods that felt like this. Not identical, never identical, but familiar in rhythm. One example is the stretch following the 2011 peak in precious metals. After the initial surge and reversal, price didn't immediately collapse into clarity. Instead, it drifted. Activity slowed. Participation narrowed. The loud voices left first. What remained was a market that looked stable on the surface but was quietly shedding assumptions underneath. Another comparison appears in late 2018. Volatility had compressed across multiple asset classes. Metals weren't exciting. Inflation wasn't a story yet. The dominant mood was indifference, not fear. What mattered then wasn't where prices were. It was how little reaction there was to information that would have moved markets just a year earlier. In both cases, the most useful signals weren't the outcomes that followed. They were the conditions beforehand. Liquidity becoming selective. Risk being repriced operationally rather than emotionally. Participants shifting from expression to preservation. But this is where the comparison ends. In prior cycles, the physical and financial layers of the metals market were more loosely connected. Today, they're tighter. Verification standards are higher. Supply chains are more scrutinized. Capital requirements are heavier. That changes how stress propagates. Another difference is participation. Retail investors today are more informed, but also more fragmented. They don't move as a single crowd. They react in pockets. That makes broad sentiment harder to read and delays consensus. And finally, the macro backdrop is not a replay. Debt levels, fiscal behavior, and monetary signaling are operating on a scale that didn't exist in earlier periods. That doesn't guarantee a different outcome, but it guarantees a different path. History is useful here only as a filter. It strips away the urge to label this moment as unprecedented or trivial. It reminds us that markets often pause before they move, not because nothing is happening, but because too many things are adjusting at once. The mistake is expecting the past to tell you what comes next. The value is letting it show you what usually comes before anything decisive happens at all. At this stage, certainty is a liability. The only honest way to think forward is in conditions, not conclusions. So instead of asking what will happen, the better question is what would need to change. Let's frame this in three scenarios. Not as predictions, but as paths that become more or less likely depending on how conditions evolve. Bull case, stability turns constructive. If real yields begin to drift lower, not through crisis, but through gradual easing, precious metals regain quiet support. Not excitement, support. If the US dollar softens modestly rather than breaks down, metals don't need a narrative to move higher. They just need less resistance. In this scenario, physical demand remains steady, not frantic. Verification costs stay elevated but manageable. Dealers adapt rather than retreat. Liquidity improves slowly as confidence rebuilds in process, not price. Price strength here would likely be uneven. Advances would come in steps, interrupted by pauses that frustrate momentum traders. That's typical when positioning rebuilds cautiously. This outcome requires patience more than optimism. Nothing dramatic needs to happen, just fewer things going wrong at the same time. Base case, compression persists. If current conditions largely persist, yields range-bound, dollar firm, but not dominant, inflation data mixed, the market stays compressed. In this case, price continues to feel stuck. Not broken, not explosive, just contained. Physical flows remain two-sided. Premiums fluctuate within a narrowing band. Sentiment stays divided and subdued. This is the scenario most participants dislike because it offers neither confirmation nor release. But historically, it's also the most common outcome in transition periods. The risk here isn't loss, it's misallocation, overtrading noise, forcing conviction where none is required. Markets in this state punish impatience more than incorrect direction. Bear case, conditions tighten, not collapse. If financial conditions tighten meaningfully through rising real yields, sustained dollar strength, or a sudden liquidity drain, pressure builds. Importantly, this doesn't require panic. It only requires capital to become more selective. In that environment, metals can drift lower even as long-term narratives remain intact. The stress shows up first operationally. Smaller dealers pull back. Inventory turns slow. Bid-ask spreads widen. Price weakness follows later, almost as an afterthought. This scenario isn't about invalidating the role of metals. It's about timing. Markets can be right and still early. When that happens, price doesn't reward conviction. It tests endurance. None of these paths are mutually exclusive. Markets often move through more than one before settling anywhere. The mistake is anchoring to the scenario you prefer. The discipline is watching which conditions are actually developing and being willing to adjust exposure without needing to justify it emotionally. That's how risk is managed professionally. Not by being right, but by staying solvent while the market decides. I don't watch everything. That's deliberate. Too many signals blur judgment. A small set, watched consistently, tells you when conditions are changing, even if price hasn't reacted yet. First is the US dollar index, DXY. Not day-to-day noise, but trend and behavior around prior ranges. Metals don't need a weak dollar to function, but they struggle when the dollar strengthens without volatility. That kind of grind quietly tightens financial conditions. Second are treasury yields, especially real yields. Nominal moves matter less than whether yields rise while inflation expectations stall. That combination tends to pressure non-yielding assets, not suddenly but persistently. Third is inflation data, particularly CPI and PCE, but not the headline numbers. I watch revisions, dispersion across components, and how markets respond after the release. A hot print that fails to move yields tells you more than a clean beat that does. Fourth is liquidity and volume in the physical market. Not social media demand, not anecdotes, but how easily metal moves between hands. Slower turnover with stable pricing signals caution. Faster turnover with flat price signals stress. Neither is bullish or bearish on its own. Context matters. Finally, I watch positioning and open interest in futures. Extremes are rare and usually obvious. What's more useful is normalization, when positions unwind quietly. That's often when optionality returns to the market. None of these indicators predict outcomes. They signal pressure. Pressure precedes movement, but it doesn't announce direction. This process isn't exciting. It doesn't generate constant opinions. That's the point. The goal isn't to react faster than everyone else. It's to react less often, but with better timing. When several of these indicators begin to align, price eventually follows. When they don't, forcing a narrative is usually a mistake. Nothing here points to urgency, and that's intentional. Markets don't demand action simply because they're moving sideways. They demand discipline when they're unclear. Right now, the environment rewards restraint more than conviction. Not because opportunity has disappeared, but because it hasn't finished forming. This is the phase where process matters more than positioning, where staying flexible is more valuable than being right early. If you manage risk, you can afford patience. If you don't, patience feels impossible. That's the difference between speculation and participation. I'm not trying to call a top or a bottom. I'm watching conditions evolve and adjusting exposure as those conditions change. Sometimes that means doing nothing longer than feels comfortable. This isn't investment advice. It's simply how I'm reading the market right now, measured, incomplete, and open to revision. Long-term outcomes are built by surviving the quiet periods, not reacting to every signal that flashes across the screen.